The United States just made a bold move, one that quietly sent shockwaves through the global financial system. JPMorgan and Bank of America, two of America's financial giants, were ordered to pull out of a Chinese IPO, not in New York, in Hong Kong. And China's response? No threats, no press conferences, just silence. Then something remarkable happened. A quiet exodus. Billions of dollars in U.S. debt were dumped swiftly, deliberately, and without warning. No headlines, no declarations, just cold, calculated exits. This isn't just about one deal. What's unfolding is far bigger. It's not a trade dispute, not a diplomatic freeze. It's a controlled detonation at the heart of global finance, one transaction at a time. Washington thought it was tightening the screws on China. Instead, it may have triggered a financial unraveling that cannot be reversed. Because Beijing isn't shouting, it's moving its money, and the global economy is shifting quietly, but dangerously. Let's rewind back to where it started. Deal that lit the fuse. It began with an unassuming IPO on the Hong Kong Stock Exchange. The company was CATL, a Chinese manufacturer of lithium-ion batteries. On the surface, it was just another listing, a projected $5 billion raise, strong institutional demand from across Asia, and solid backing from top underwriters JPMorgan, Chase, and Bank of America. But in Washington, alarms were already ringing. On March 27, 2025, the National Security Council issued a quiet but urgent warning. CATL, they claimed, was no ordinary battery firm. Its lithium-ion technology, already fueling China's electric vehicle and energy storage revolution, could soon power its submarine fleet. Worse, its ownership traced back to entities tied to state-run defense laboratories. The listing wasn't happening in the U.S., but that didn't matter anymore. Within 48 hours, both American banks abruptly withdrew. Billions in valuation evaporated. CATL's expected market cap plunged by $210 million overnight. The move spooked investors. But more importantly, it sent a message. The United States was extending its financial power beyond its borders. Analysts at Georgetown's Center for Security, an emerging technology, gave it a name: extraterritorial capital deterrence. A new financial doctrine where U.S. firms are no longer guided by profits, but by Washington's strategic playbook. Follow the flag or get left behind. The global message supporters, it was a smart strike, a necessary check to prevent Wall Street from fueling China's rise in defense-critical sectors. CATL wasn't just a battery company. It was a cornerstone of China's future war machine. But critics saw something darker, a move that could shatter America's financial credibility, by using national security as a lever to influence private capital. The U.S. had changed the rules. If firms can't operate freely in global markets, what happens to their relevance? What happens to trust? And more troubling still, Hong Kong was no longer neutral ground. Once the bridge between East and West, it's now seen as Beijing's financial proxy. And by interfering there, Washington was tacitly admitting the old playbook no longer applies. So, was this a clever containment strategy or a desperate attempt to slow a changing world? One thing is clear, that IPO was a line in the sand. And China was quick to respond, not with words, but with capital. The silent retaliation. China didn't issue threats. It didn't hold emergency summits. It just moved its money. Within 72 hours of the CATL withdrawal, Chinese state banks and sovereign wealth funds began offloading U.S. Treasuries, quietly, deliberately. According to Treasury International Capital (TIC) data, China slashed its U.S. debt holdings by $78.5 billion in Q1 2025 alone, the sharpest single-quarter drop since 2016. Beijing's total exposure to U.S. financial assets which once stood at $1.67 trillion, is now in freefall. But this wasn't a tantrum. It was a strategic exit. Barclays head of macro strategy A.J. Rajin called it diversification cloaked in diplomacy. China isn't panicking. It's planning for a world where it no longer needs the dollar. Where is the money going? So where's all that capital headed? Bloomberg reports a rapid shift into non-dollar assets: gold, BRICS infrastructure bonds, and yuan-denominated debt. The Shanghai Gold Exchange just hit a 5-year volume high. Physical gold purchases by Chinese institutions are surging. But China isn't just buying, it's building. Billions are being funneled into new trade corridors and regional investment. Networks that operate outside the dollar-dominated system. Lending in local currency. Settlements outside of SWIFT. Infrastructure bonds priced in yuan. Even more telling, in Q1 2025, Chinese purchases of Japanese government bonds jumped 28%. Why Japan? Liquidity, reliability, and a non-dollar hedge. What we're witnessing isn't a retreat. It's a repositioning. China is stepping out of one system while assembling another. The ripple effect. Wall Street is already feeling the tremors. As China trims its U.S. debt exposure, the Treasury faces a harsh reality. Rising yields not from inflation, but from vanishing foreign demand. If China won't show up at bond auctions, borrowing costs rise. Debt servicing becomes more expensive. And the dollar, once the unshakable pillar of global finance, starts to look vulnerable. We're watching a cold financial decoupling, not with sanctions or speeches, but with spreadsheets and sell orders. And China isn't doing this alone. Other nations are watching, taking notes. Some are already following suit. Washington's next move, while China moves in silence. Washington is preparing something louder. In April 2025, the Senate Banking Committee advanced a rare bipartisan bill, a legislative assault targeting over 220 Chinese companies tied to AI, defense, biotech, and telecommunications. The goal? Force U.S. investors to divest. According to Bloomberg, these firms represent $812 billion in U.S.-linked capital held in ETFs, index funds, pensions, and American depository receipts, ADRs. If the bill passes, major players like BlackRock and Goldman Sachs would have 12 months to unwind their positions. BlackRock alone manages $115 billion in Chinese assets, all now under scrutiny. And the consequences? Massive. Passive funds especially. Emerging market ETFs will be hit hardest. These funds aren't designed to play politics. But now, politics will override portfolios. Forced liquidations would distort prices, dry up liquidity, crash valuations. Wall Street's footprint in Asia's $34 trillion market could vanish overnight. China builds a new system. So how is Beijing responding? By building something far more ambitious, a financial system that doesn't need Wall Street at all. In early 2025, China's Central Financial Commission committed $423 billion to expand domestic financial infrastructure, on underwriting platforms, cross-border settlement systems, and homegrown fintech tools. One of the biggest shifts? China is phasing out Western credit rating agencies. By 2026, Moody's, Fitch, and S&P will be fully replaced by domestic rating firms. Beijing no longer wants Western approval. It wants independence, and it's already attracting international capital. In Q1 2025, the Shanghai International Board, the Chinese equivalent of Nasdaq, recorded $112 billion in foreign listings. Not just from China, but from Southeast Asia and the Middle East. Firms that once chose New York are now choosing Shanghai. Why? Stability without geopolitics. Capital without fear of sanctions or sudden delistings. A system that doesn't change. Based on Washington's mood dot, and it's not just China. Regional banks and Gulf sovereign wealth funds are supporting this shift, redirecting deals and listings into Asia's rising financial centers. Daniel Rosen of the Rhodium Group put it bluntly. Wall Street's retreat isn't slowing Beijing, it's accelerating localization. BRICS, and the rise of a parallel order. At the heart of this transformation is the BRICS bloc, emerging as a parallel financial system. In Q1 2025, the BRICS interbank payment system processed $56.4 billion in cross-border settlements, a 320% increase. Year-over-year. These aren't symbolic moves. They're a real exit from the dollar. China is providing over 65% of the yuan liquidity in these deals, and others are lining up. In April, Saudi Arabia issued a $4 billion bond fully priced in yuan. It was 4 times oversubscribed, with investors from Brazil, India, and Egypt rushing in. The message is clear. You no longer need the dollar to raise capital. Meanwhile, IMF data shows the U.S. dollar's share of global reserves has fallen to 57.4%, its lowest level in 28 years. Still dominant, yes. But the decline is no longer marginal. It's structural. The new question for decades. Wall Street was the gatekeeper to global liquidity. A listing in New York meant prestige, access, credibility. Now, emerging markets no longer need America's blessing. They have options. They're building lifeboats before the next wave of sanctions. And each new yuan bond, each non-dollar transaction, chips away at the old system. The U.S. still holds immense financial power, but it's using it like a hammer. And the world is adapting, because this isn't about size anymore. It's about speed. Washington argues. China builds, U.S. banks pull out. BRICS banks move in. One IPO at a time. 1. Treasury dumped. 1 yuan bond sealed. This is not background noise. It's a financial power shift, engineered in silence, executed through capital. So here's the question. Is the world still following America's financial lead? Or is it already halfway out the door? If you found this breakdown helpful, like, comment, and subscribe for our next deep dive. This story isn't over, and neither is the global power shift it's unveiling.